Looking for passive income that can help fuel your financial independence? Real estate investment trusts can be a great way to increase your personal cash flow with yields close to twice that of 10-year treasuries. If you're interested in generating passive income and want to learn more about fund options, then subscribe to the channel and join me today as I compare 7 real estate funds right here in the red zone. If this is your first time to the channel, I introduce the easiest way to gain exposure to the real estate sector, as well as a brief overview of the funds that I'll be comparing today in this episode. From that episode, here's a summary of characteristics that I liked about each one of the funds. Notice that the majority of these funds are paying around 8 or more percent, with the exception of VNQ from Vanguard and XLRE from State Street, which are two passively managed index funds in the sector. We'll use this scorecard today in our review, so without further delay, on to round one. In round one, we'll look at total returns starting with year to date. IYRI from NEOS, which just lost this year, wins at 10.76%, as its price has been relatively flat, but pays close to 10% monthly in a monthly dividend. And IYRI is followed by RFI and RQI as next as far as year to date. If we go out to 3 years, we see PFFR take the lead and a lot of bunching between our other options, with RIET being the worst fund for that time period from a total return standpoint. When we go back 5 years, RIET is again the worst, although it hasn't been around for 5 years yet, and we see RQI and RFI toward the top. If we go all the way back a decade, we still see RQI and RFI in our top two positions. What is interesting is that the overall real estate sector in general has not been very good in the past decade, and therefore higher dividends in this sector that do not have assets or strategies eroding their net asset value are beating out our lower paying, more standard index funds from a total return standpoint. Round one is going to RFI and RQI as winners, with RIET's performance less than awesome. So, sorry, you're knocked out in this round. On to round two. Next, we'll look at yields and dividend history. RFI, RQI, and PFFR are unblemished, and as of this video recording, yields with RFI at 8.11%, RQI at 7.77, and PFFR at 7.79%. IYRI's short dividend history shows it's more variable in terms of its distribution based on its covered call strategy, with a yield of about 9.5%. VNQ and XLRE both have lower yields, with VNQ at 3.83% and XLRE at 3.27%. Now, here's where strategy comes into play in terms of what exactly do we want these assets to do for us. So, allow me a few moments to explain. Do we want these assets to be totally consistent in their payout, but really never grow their payout? Well, that's what we find with RFI, RQI, and PFFR. So, the payout of these assets will ultimately lose purchasing power in the long term due to inflation because they're never growing their dividend. But their starting yields are fairly high at close to 8%, so they are really good for near term income. However, if you want that income to grow, then you'll have to reinvest some portion of the distribution even when you are retired. With IYRI, we will likely get similar results if the seemingly sideways moving real estate sector trend continues, with an added strategy risk in IYRI due to its use of options. Now, another possible utilization of these assets would be to support a dividend growth strategy. So we could accept a lower payout now for a potential higher payout in the future. It's why in my red zone portfolio, I hold a large allocation of about 20% to SCHD. If you're unfamiliar with dividend growth strategy, I covered it in this video, and in that video used SCHD as an example asset to demonstrate the dividend growth strategy. Now, in my situation, I'm selecting assets for the income portion of my portfolio, which is basically meant to provide income for an early retirement to bridge to age 59 and a half, when then I can access my retirement accounts penalty free. The income investing strategy portion will still provide income in later retirement as well, but I'll likely have to reinvest dividends periodically. So, in my case, I need money from this portion of my portfolio more in the next decade than 2 decades from now. Now, even if I didn't, or if dividend growth better fits your specific situation, unfortunately, it doesn't really look like VNQ or XLRE are good options, as they don't really have a consistent dividend growth story. So, at least over the past decade, you've been better off in the real estate fund asset class owning income versus dividend growth style of assets because there is no consistent dividend growth. Now, there is consistent dividend growth in many REITs. For example, Realty Income, ticker symbol O, has 31 years of consecutive dividend increases. So, if you want to allocate dollars into real estate investment trusts, as part of more dividend growth strategy, then individual stock selection seems a better way to go than picking a fund. So back to our comparison. In this round, I'm getting rid of VNQ and XLRE because they don't fit the strategy for my portfolio. Nor do I see those funds as being particularly good for the dividend growth part of my portfolio. If I did want to find REITs that fit that purpose, I may have to look at individual positions. On to round three. From an expense standpoint, PFFR has the lowest expense ratio out of our three remaining funds at 0.45%, followed by RFI at 1.34, and then followed by RQI at 2.21%. RQI also uses leverage, which is very common with closed end funds, while RFI, although it's also a closed end fund, does not. In an excellent article by Reader's Digest on Seeking Alpha, the author demonstrates the additional downside risk that RQI's leverage introduces using the April 2025 market decline as a case study. Due to a desire to preserve capital and not introduce additional downside risk in this sector, I'm eliminating RQI. On to round four. In round four, we take a look at risk, and from a credit quality standpoint, only about 20% or a little bit more or so of PFFR's holdings are considered investment grade, while both RFI and IYRI's portfolios are more representative of higher quality holdings. PFFR isn't really compensating with a higher yield for the additional risk it seems we're taking, and therefore PFFR is out. Round five for me is really more subjective. Here I'm looking at track record. RFI's tenure as a stable paying fund since 1992 blows away IYRI's tenure as a brand new fund launched this year that is riding a wave of popularity currently for covered call funds. So, for that reason, I'm picking RFI as the winner, although I do like what IYRI has to offer. As I build out my red zone portfolio, here's what it looks like at this point of time. I've decided to allocate 8% of my overall portfolio to the real estate sector, with 6% going to RFI as the winner, but I'm willing to allocate 2% to IYRI despite its newness. As you recall from previous episodes, I've selected UTG for my 6% allocation to utilities and PFFA for my 6% allocation to preferred assets, primarily in the financial sector. I still have 20% of the overall income portion of my portfolio uncommitted. So, which real estate fund or individual holdings do you invest in? Leave a comment below and let the community know, and also let us know why you chose those particular investments. Until then, I'll see you next time, right here in the Red Zone.